Yeah, hi friends. Hope all of you are safe and healthy. Right. Let us now look at the RTP for May 2021. Okay, a good RTP. Seriously, I feel. All right. Having a look at this RTP, if you have a look at this, it's obviously is going to be good experience, and you can test your understanding of IND AS. You know, IND AS is obviously ocean, correct? Without any doubt. Even I read it for a number of times. I'm applying in all my IND AS clients. I'm doing this conversions for so many years. Right. Still, if I read, still I'll see one different angle. And again, one more thing. When I see, in the client's place, when I face a problem, even though after reading so many times, still correct. No, I feel like no, I have to rethink, and again read once again, because that beautiful is this subject. Okay, right. Anyhow, as I said, it's very good one. Why can't we have a look at it? Correct. It's very good, I feel. Right. Hello, let me try what I can add to your knowledge. Right. Yeah. So this RTP, right? First question is all about like IND AS 101. Right. This is this is what generally I tell my students. This is the standard which we should read at the end. Yeah, this is the first option, but reading last. Otherwise, you can't answer. Because it's linked to all. A beautiful, obviously beautiful. The implication, no. When you read the standard, when you apply when you actually practically apply it in the client's place, really, what is the knowledge you have, that will be tested, right? And one more general point. Generally, students nowadays, and they are just reading it. Okay, for examination, if I pass, sufficient. If I pass, sufficient. Correct, you will pass, pakka. I know that. But after passing, again, will you read the IND AS? Correct, no? When you go it for interview itself, obviously people will ask what? First and correct, no? Foremost question, obviously on accounting standards and IND AS only. And since you studied it, they expect a lot from you. Whether who is asking, that person knows, do not know, but pakka he will ask you on that only, and he expects a lot from you because you are a young, energetic. Obviously, correct, no? That is not obviously bad expectation, correct expectation. Then what do you do that time? This subject, especially financial reporting, if you read it only for the purpose of passing the exam, no, I feel, that's my personal opinion, you are doing a big mistake. You are doing very big mistake, right? Because this is useful throughout the life. If you wanted to continue in this accountancy field and the job or somewhere, very much necessary. Maybe in the near future, I don't know exactly. Maybe all the companies may need to apply. That may come. It may come. It has to come, actually. It will come, I feel. But you have to be equipped with accounting, and especially IND AS, right? You have to be equipped. Fine. That's anyhow, that's my point of view. Chalo, let's get into in the first question, IND AS 101. Yeah, see, it's first adoption. This talks about how are we supposed to measure on the date of transition. Correct, no? Right. Because as per IND AS 101, first paragraphs, it says, as if you have to follow from the retrospectively from the date of incorporation, you have to apply all the standards, but except a few exemptions, which are some are mandatory, some are optional. Correct. So when it is optional, then accordingly it is depending upon the entity's decision. Got it? Right. So all that we are supposed to keep it in mind, then only we will be able to answer it in the best fashion. Okay, right. Chalo. So HIM Limited having net worth of 250 crores. Yes, having net worth of 250 crores, 250 or above, IND AS is applicable. Correct. Again, net worth has its own definition that you must have studied. It's required to adopt IND AS from 1st April 2002. Okay, this is the right you are supposed to follow. in accordance with the Companies Act, whatever rules 2015. Done. Rahul is a senior manager of the company, has identified following issues which need specific attention of CFO so that opening IND AS balance sheet as on the date of transition can be prepared. Okay. Issue 1. As part of PPE, company has elected to measure land at its fair value, right? And wants to use the fair value as a deemed cost on the date of transition, right? The carrying value of the land on that date is 5 lakh, wherein the land was acquired for 5 lakh. Yes, that is the cost. However, the fair value of the land was on the date of transition is 8 lakh. Yeah, as per IND AS 16, you have a choice that is optional. That is, what is that? You can follow deemed cost. What can be deemed cost? They have given 3 choices. One is fair value on the date of transition. The next one is previous gap carrying amount. And other one is again fair value, but it is indexed cost fair value you can follow. Or you want to follow retrospectively, that option is always with you. Right. Since he said we wanted to value at fair value, that is the choice taken by the company. Okay, measure at fair value. So, but okay, you will increase the land by 1 lakh and our difference has to go to retained earnings. Retained earnings, correct? Na? So then what is the journal entry you can pass? That is land account debit to retained earnings, 1 lakh, 1 lakh. This is what you are supposed to recognize it on the date of transition. Right, on the date of transition, you are supposed to give a reconciliation statement. It is a reconciliation statement is necessary. Correct, na? Right. In the reconciliation statement, you have to explain that. Retained earning fluctuation you are supposed to explain, and which number has gone up, down, everything is supposed to be explained in the reconciliation statement as part of first adoption. Done. Next, issue number 2. Under IND AS, the company has designated mutual funds as investments through fair market FVTPL. Mutual fund units can fit only under FVTPL. It cannot be FVTOCI because it is not solely SPPI test, solely in the principal and payment of interest. No, it is not. The SPPI test cannot be satisfied. And correct, no? Obviously there is no maturity, nothing is there, right? It obviously has to fit it under FVTPL. Perfect. So the value of mutual funds as per the previous gap was 4 lakh, which is cost. Now the value, correct, this is the fair value. Yes, FVTPL has to be measured at fair value on the date of transition. No exemption, follow it. That means what should I do, sir? What should I do? That is investment in mutual fund, how you named it, account debit. This is also again to, this is 1 lakh should be transferred to retained earnings. Next, the company had taken a loan from another company. Then the loan carries an interest rate of 7% and it had incurred certain transaction cost while obtaining the same. Correct. Since it is a loan, if you had incurred any transaction cost like brokerage cost, processing fee, something, whatever it is supposed to be reduced from the loan amount. Correct. As per IND AS 109. If it is with respect to equity, reduce it from the equity. If it is from financial liability, reduce it from financial liability. Done. And will obtain the same. Okay, done. It will be carried at cost on the initial recognition. The principal amount is repaid in equal installments over the period of loan. It's already done. Interest is also payable at every year end. The fair value of the loan as on the date of transition is 1,80,000 against the carrying amount of 2 lakh. Okay, that means it must be 20,000 is transaction cost. Correct, na? 20,000 what you would, what is the fair value? Now fair value of the loan is how much? 1,80,000. Agree? Right. See, actually for the loans you don't have any option. You have to first go back and retrospectively do it. Then in case if it is impossible for me to go back and come back, generally it is possible. Practically it is very much possible. Some very rare circumstance may, I don't know exactly, because what all the clients I have seen, it was very much possible. Okay, right. So in the worst circumstance, what can you do? You can measure it at fair value. You can go with fair value. This you can say, I'm measuring at FVTPL. The minute if you say I'm measuring at fair market value through PL, then there is no concept of transaction cost adjustment, nothing. Directly fair value measure. But already carrying amount is how much? 2 lakh. Correct now. It is a loan. Loan is to be reduced. Reduction of loan is what? Nothing but income. Correct now. That's why what is the journal entry you should record? That's a loan account debit to retained earnings to the extent of 20,000 you will be recording. Issue number 4. Right. The company has declared a dividend 30,000 in the last year. On the date of transition, the declared dividend has been already deducted from the reserves and surplus. Okay. Dividend payable has been grouped under provisions. See, suppose it was declared in the for the last year. Okay, you declared for the last year means in the current year, but it was already deducted on the 31st March. See, that it was declared by the board at the time, and it was approved by the annual general meeting of the shareholders. Obviously, annual general meeting takes place after 31st March, not obviously on 31st March midnight, right? So subsequently, company has ratified whatever you have done as on 31st March. Was it a liability? It was not. Correct now. It becomes a liability only when it is approved by the members in AGM. So on 31st March, we were not liable to the members to pay dividend. So what are we supposed to do? Reverse it. You have to reverse it because it was not liability on that day. They created a liability. Correct now, as per the old gap, actually accounting standard 4 also says not supposed to do. It's okay. They have done it. We will correct it. Yeah. So what is the journal entry you would have recorded? Reserves and surplus, retained earnings account debit to provision for dividend you must have made. Now ulta. Ulta means what? You should say proposed dividend or dividend, whatever the name you used earlier. Correct. Now that should be retained earnings. Obviously, whatever the number, 30,000. This is what you are supposed to do it. Okay, right. Next. And fine. Issue number 5. The company had acquired intangible assets. This is with respect to intangibles as a trademarks amounting to 2,50,000. The company assumes that it have indefinite life of these assets. Okay, they feel that's indefinite. The concept of indefinite is there only in IND AS. In AS, obviously not there. Right. Next, the fair value of the intangible assets as on the date of transition is 3 lakh. However, company wants to carry the intangible assets at 2,50,000. Welcome. See, deemed cost is a choice. Correct na? Deemed cost is a choice. It's not necessary that I have to go with fair value. Correct na? Right. And in the first question you said PPE, you want to follow fair value. Fine, that is with respect to PPE. This is with respect to intangible. I can have my own choice. I may follow deemed cost. Deemed cost is nothing but previous year gap carrying amount. Yeah, as we are dealing it as what? Indefinite. Then there is no depreciation. But when you said it is indefinite, you should write lines like impairment is supposed to be tested at the end of every year, irrespective of the, what is that? Indicator. Correct. Irrespective of impairment indicator, you are supposed to check for impairment. Right. Here, nothing to do. This is okay. Right. This is okay. Nothing to do. That is their choice. Who am I to say, no, this is better you follow? Correct. Na? Obviously not. Right. Issue number 6. After consideration of possible effects, as per the IND AS, the deferred tax impact is computed as 25,000. Yes. Obviously, see, when you have changed the numbers, you are your deferred tax is supposed to be computed once again. Right. So now this amount will further increase the portion of deferred tax liability. That means deferred tax liability is getting created. No problem. Yeah, because everywhere it's retained earnings is going up. Correct. Now that means profit is up. Profit is up means you are liable to pay tax. You don't pay because department will not ask, but we will be recording as deferred tax liability. Correct. Now there is no requirement to carry out separate calculation of deferred tax on the above adjustment because he did not give what is the rate of tax and etc. It's okay. He said number. Why will I calculate then? Correct. Now, so what are you supposed to recognize? Mandatorily. Correct. Now, deferred tax liability means obviously expenditure. This is not deferred tax expense account. Retained earnings account debit to deferred tax liability because it is all happening on the date of transition. So 25,000. Hope you got it. Right? We had that good question. Right? That's what already we have done. Right? You can read it. IND AS 2, this is very small question. I mean, size wise big, matter wise nothing. Okay, right. On 1st January 2001, the entity accepted an order of 7,000 custom made. Okay, we accepted. We'll make some customized product. Done. 3rd January, we bought the raw material. Okay, fine. We got the raw material. See, what is the question he's asking? Let's read. Compute the cost of inventory. Done. Substitute your answer with appropriate reasons and calculations whenever is required. Okay, we'll do it. Right. And what is that? Cost of inventory they wanted. Done. It's to be consumed in the production process for 5,50,000, including 50,000 refundable purchase taxes, kind of GST. Okay, it's refundable. Refundable means what? You're getting back. What is cost? Cost is what you lost. Have you lost? No, I have not lost. What you lost? 5 lakh rupees only lost. Then you should take only 5 lakh rupees as your cost. Material. Correct, na? The purchase price was funded by a raising loan. Right. This is borrowing. I mean, you are trying to say loan cost and etc. This is, I mean, loan fees is borrowing cost. Correct. Borrowing cost. Do you capitalize? No. If you see the question, my dear, right here it's given. The gift was ready for sale on 1st March. That means within 2 months they were able to complete it. So this inventory is not a qualifying asset. This is not a qualifying asset. Borrowing cost cannot be added to my inventory. Done. Right. Next. During Jan, the entity designed the corporate gifts for the customer. Design costs includes. What does it include? Cost of external designer. Yeah, very much required. This is all correct. Now, other cost may you can put it. Yes, take it. Labor, very much. That is in the month of Jan. Right. During February, okay, next month, the entity production team developed the manufacturing technique and made further modification necessary to bring the inventory to the condition. Okay, they brought another materials, but it is net of 3,000 recovered from the sale of scrap. At the end of the day, what is my loss? What I lost is cost. Cost is 21,000. Take only 21,000 rupees as material cost. Done. Next, labor, obviously yes. Depreciation, yes. The asset is being used for manufacturing. Yes, it is part and parcel of my cost. Done. Consumable stores, yes, which is very much necessary. Labor, yeah, it's also part and parcel. Depreciation, yes, for the next month. Done. You have to take all except what is that? The borrowing cost, any interest cost or any other fees. No, you are not supposed to take it because it is not a qualifying asset. Other than that, all other things are supposed to be considered for your inventory cost. Right? Yeah. IND AS 8. Somewhat good, but not that great. In 2003-4, after the entity's 31st March 2003 annual financial statements were approved for issue, okay, the latent defect in the composition of new product, okay, there is a defect in the composition of new product manufactured by the entity was discovered. Okay, the defect that could not be discovered by regional or customary inspection. This is the important point. This is the important point to catch. Yeah, we found afterwards on 31st March, if you had applied reasonable knowledge, reasonably, if you had looked at, you would have not actually. That means it is not an error. From that word we can catch it is not an error. Correct? Na? Error means, I mean, if I had applied reasonable knowledge, I would have got it, but I could not get it if I say. So you understood my point? What did I say? I would have got it if I had applied reasonable knowledge, but I did not. Then that was an error. Correct? It's our mistake. But in the given case, what is he saying? It could not be discovered by reasonable or customary inspection. No, that means something problem, serious, in-depth problem was there. Okay. As a result of the latent defect, entity incurred 1 lakh in the unanticipated cost for fulfilling the warranty obligation in respect of sales made before 31st March. Okay, correct. Already so goods are sold before 31st March, right? I mean, obviously, because the problem was there. Subsequently, we spent 1 lakh on that. Done. And additional 20,000 was incurred to rectify the products sold. I mean, till you found the problem. Next. And 5,000 which relates to item of inventory, which is there on 31st March, goods. I mean, lying goods, also you spend some money. Right. And the defective inventory was reported at cost, 15,000. But anyhow, when the selling price less cost to complete and sale was estimated to 18,000, fine. I mean, NRV is higher. The accounting estimates made during the period on 31st March, financial statements were appropriately made using reliable information. The entity could reasonably be expected to have been obtained and take into account the preparation presentation of no other mistakes are there. That's all in simple words. Okay, right. So now what are we supposed to do? Simple, ma. This I told you, E line is important. The defect could have not be. I mean, we are by applying the reasonable knowledge, I will not be able to find out. That means it is not an error. Purely not an error. Okay, right. If I said the minute it's not an error, you don't need to go for retrospective application. Retrospective restatement. Not required. Okay, then what should I do? Nothing doing. It's all prospective accounting. We'll treat it as change in accounting estimation, but not prior period item. Okay, it was not an error. Hope you understood. Fine, right? That's it. That is, this word, if you have read correctly, then the definition of error, if you have read correctly, this is very simple. Nothing is there. Correct? Now, retrospective restatement is not required. In the current year, all the charge, whatever you have spent, everything will be booked in the current year profit and loss only. Not going to be booked in the question number 4. Right. This is with respect to intangible. What is that? Intangible assets. That is IND AS 38. A basic question, not that great, but the institute suggested answer is a bit different. Okay, we can. What they have given is obviously correct, no problem, but we can answer in little different way also possible. Okay, right. Let us read it. PQR is a gaming developer company. Few years back, it developed. Okay, it developed a new game. Correct. When you have developed a game, it is not freely coming. You developed it, means there will be development costs. Agree? Right. So as per, if you are developing self-generation of an asset, right, we have to divide that entire phase of development into research phase and development phase. The cost related to development phase can be capitalized subject to 6 criteria given in the standard. Okay, right. Let us assume if it was satisfied, there will be some amount with respect to development. Intangible asset, because it's already been developed long ago. Now it is intangible asset. Okay, right. And this game sold over 10,000 copies around the world and extremely profitable. Okay, done. Due to this popularity, they released a new game in the same Cloud9 series every year. The game continues to be bestseller based on the management expectations, estimations of the cash flow projections for the Cloud9 video game series for the next 5 years. Okay, they prepared something, fine. Projections. Based on these projections, PQR Limited believes that Cloud9 series brand should be recognized. Okay, it's a brand he's talking now. That word. Okay, not the development cost. Development cost is already must be there. But anyhow, he's not talking about it. Okay, the brand should be recognized at 20 lakh. See, this is you are saying this has become a brand. Okay, based on the name only, we are getting a lot of money. Correct, na? Right. See, based on the name only, you are getting a lot of money. I want to recognize the brand. My dear, first of all, isn't it a self-generated brand? Correct. It is an intangible asset. I agree. Because first of all, it is intangible, identifiable, non-monetary asset without physical substance. Yeah, definition satisfied. Because it is identifiable. You can sell only the brand, right? Very much. It is non-monetary. It is not creating any payable or receivable to the company. Correct? It is non-monetary. Yes, it satisfies the definition of intangible. Correct. And it satisfies the two conditions of asset also. There is probable future economic benefits inflow. Yes, yes. If I sell, I'll get a lot of money. And I can measure the value. Yeah, there are so many methods to measure it. But okay, but the point is, this is self-generated brand. Recognition of self-generated brand, self-generated goodwill are prohibited by the standard, first of all. Got it? Right. So that is the reason we say, what do we say? We shouldn't recognize the brand. Brand should not recognize. Whatever the development cost, whatever they have spent, if they had already, but anyhow, he's not talking about how much amount, etc. Nothing he spoke about it. So development cost may be there. That development cost, if you want to follow revaluation model as per IND AS 38, revaluation model as per IND AS 38 permitted. But brand, this is self-generated, correct? Na? It is self-generated. It is self-generated, obviously not permitted, not allowed. You cannot recognize it at 20 lakh, correct? Na? They simply say one sentence actually. I mean, not on anybody. It's okay. There is a paper setter way. They recognize a brand. Recognition means what? Recording in the books of account. Correct. Recognition means okay. Brand account debit. Credit what then? Credit what? Liability. Yeah? You are not liable to anybody. That means is it retained earnings? Profit and loss? Right? Where you want to do it? I mean, this is all correct. Now you cannot make, first you sell it. When you sell it, that day only that money will come. You have not spent any money, right? We cannot take that. Fine. Anyhow, it cannot be recognized. Then PQ also paid 10 lakh to an MNC to acquire rights of another video game. Correct? Now called some headspace. Yeah, this you paid, na? Right? This is paid money. Correct? Now this you recognize it. You recognize this number because this is the cost. We know very clearly. Got it? Yeah, the said series has a huge demand in the market. Whatever, that means whatever you have paid is also fair market value only must be. Fine. You recognize 10 lakh, there is no issue. But with respect to self-generated brand, you should not. Okay, right. Next. Fifth one. Yeah, here it says IND AS 37, IND AS 115. It should say IND AS 10 also. Less simplification of IND AS 115 actually. Right, more of 37 and 10. Right, anyhow, it's not, I mean, good, I mean, not that great. Okay, reasonable. A manufacturer gives warranties to the purchaser. Okay, the minute warranty comes to your mind, two standards should click to your mind. One is 37, another one is 115. Obviously, correct? Na? 115 also. Yeah, sometimes warranty can be a separate performance obligation. Yeah, can the warranty be purchased by the customer separately? If you say yes, it is a separate performance obligation. And is that warranty only for the manufacturing defects and performance? Is it only for the assurance of the performance of the performance? Then it is no separate performance obligation. No, it is bit beyond. Bit beyond means what? I purchased one, say not mobile, I know that. Okay, I purchased a mobile. It dropped from my hand. Correct. It fell down. Of breaking. Correct. Breakage. I threw it in water. Some problem is there. Still he is rectifying. Yeah, some physical damage also is covered, means that is one kind of, that is one more separate performance. That is a separate performance obligation. That's why you have to, your mind should look at immediately two things. One is 37, one is 115. Okay, as we have already discussed this in the class, I think you must be catching it. Right. So the manufacturer undertakes to make the good. That's all. He undertakes the warranty. What is under terms of the warranty? Manufacturer undertakes to make good by repair or replacement any manufacturing defects. Only manufacturing defects. Suppose you throw it somewhere. I will not give any warranty for that. That means what? There is no separate. You have to write that sentence. Correct. Now, if you simply, I mean, they have given some line, means there must be some meaning to it. Sometimes they will give to, I mean, it can be a biscuit also. Possible, very much. But we are supposed to answer like that. Okay. No separate performance obligation. That is one point. Okay. Within 3 years is the period from the date of sale. Done. On 30th April, the manufacturing defect was detected in the goods manufactured. One second. Yeah, so manufacturing defect was detected in the goods manufactured by the entity between March to 30th April. Okay, so they already manufactured some goods, obviously from first March to, these 2 months, but they found that there is some fault in the production itself on 30th April itself. Obviously next year. 31st March 2001, this is the balance sheet date. The entity held approximately 1 week sales of inventory. Okay, how many, 1 week mein how many goods it will generally sell, and that many goods are there on the balance sheet date. Okay, that is closing stock. Okay, fine. Next, what? The entity financial statements for the year ended 31st March have not been finalized. Okay, it's not been finalized. Doesn't matter. 3 separate category of goods require separate consideration. Okay, right. Let us answer one by one. Yeah, he's asking accounting treatment for each one. Okay, category 1. Defective goods sold on or before 31st March. You already sold defective. Correct. Now, we got to know that there is some defect. Obviously, correct. You must have assumed we must have already made a provision for warranty, sir. Correct. You must have made it. But the defect is, it may be big. You should now check whether whatever the provision made already with respect to warranty, is it sufficient? Correct. Maybe it is, you must have made normal warranty provision. It is a defective now, big defect is there. People will come for replacement or something. So now if you feel that that warranty provision is not sufficient, you should make further provision. Correct? Right. Do you need to make a provision or not? Yes, because you already promised. Provision is must. You already promised. It's a contract. It is an, what is that? It is a contractual arrangement, contractual obligation, that you already promised that 3 years you will give the warranty. There is a problem in the product, you should make a provision for that warranty, maybe a bit higher than normal depending on the circumstance. Then category 2, defective goods are held on 31st March. Okay, it is not sold. This is sold, this is not sold, this stock is with me. Correct. Now, if it is with me, are we liable? Are we liable to anybody? No, if I have sold, then I am liable. Anyhow, I got to know, then what do? I will rectify the error at the same time. Because on the date of 31st March, whatever the goods are there, those goods are in, defective condition. Correct. Na? So when you are trying to calculate cost or NRV, whichever is lower, the NRV must be lower. It will be not the normal NRV. NRV may be comparatively lower. Correct. Na? Right. That is supposed to be considered, but there is no provision is required. What do you say? No provision is required, but what are you supposed to do? Yeah, consider in the valuation. Consider in valuation of what? Consider in valuation of inventory. Inventory valuation may consider karo. Because see, cost is cost, you already know. Correct? When it comes to NRV, you must have something, let us say 100 rupees is the NRV. You may need to spend additionally another 20 rupees to make it ready for sale now without defect, to clear the defect. Cut it from the NRV. Okay, now you say 80, you take it. Right. Suppose what is the cost, depending upon whatever the number of this, whichever is lower, that should be considered, because your books of accounts are not closed. Financial statements are not finalized. Right. You can consider the valuation of inventory properly. Then next, the third one, defective goods are manufactured in next year. 2021 means obviously 12 means next year. Nothing will be done. Correct. Na? Right. This will be, what do you do? As on 30, see, the point is the entity financial statements year end is this. Right. Now, do you need to do anything? Nothing to do. Right. Nothing to do, because we are trying to close the last year books, not in the current year books. Any problem, any expenditure to correction and everything will be booked in the current year itself. Got it? Right. These two things, obviously, these two, this is purely what? This is purely non-adjusting event, I can say, if you try to link it with IND AS 10. Yeah, this is, since financial statements are not closed. Correct. Na? Are you supposed to make a provision? Yes, it's purely adjusting event. Correct. It is purely adjusting event. Yes, even this one also I can say this is purely adjusting event. There was defect, I was not aware. Subsequent information is giving clarity about the defect. Subsequent information is giving clarity about the NRV. You should consider. valuation of inventory. Okay, done. Now this is very good question. I mean, requires a lot of judgment actually. Okay, right. Maybe this kind of question I doubt whether they ask in the exam or not. They can ask obviously, but good one I can say. Right. Question number 6. An entity has the following items of PPE. Done. Property A is a vacant land. See, first of all, what is the question he's talking? How many classes of PPE are there? Okay, classes, each class of asset. Right. Class means under the PPE you will write land, building, right, furniture and fixture, plant and machinery, something like that. These are all, each one is class, one class, right? So how do you, in the given circumstance, like what is that, 1 2 3 4 5, so many items, 9 items are given, 9 or 10 items are given, whatever, you have to decide how many classes will be there. Okay, let's see. Vacant land. Okay, it's vacant land, vacant plot of land on which intends to construct its new administration headquarter. Yeah, they wanted to construct administration headquarter. All are PPE only. You are not deciding whether it's a PPE or investment property. Yeah, it is PPE. Okay, right. But it is, as of today, what is it? Vacant land. Okay, done. A plot of land that it operates as a landfill site. The landfill means generally, general meaning I am giving you, right? I don't know what is the specific point here. Generally where you keep the wastage. Okay, it is not meant for any construction, garbage kind of area. Okay, that is a plot of land which is existing administration building. Okay, means it's land on that already building is constructed, means land with building. First one is khali land, second one is khali land, but it's being used for some different purpose, right? And again, next, a plot of land on which direct sales office is built. Correct. So I can say these two are one classification, I can say. Right. One more also. Let me write. Hold on. Let me read full. Property even and whatever. 10 separate retail outlets. Okay. And the land on which they are built. Okay. When you say retail outlets, retail outlets also, what is that? This is also generally like administration building or office kind of thing only. Okay, right. It is, if you feel, but anyhow, one has to analyze it bit. Bit personal judgment is required. Shall we say this is an administration or office building, or shall we say, different kind of, right? Because it's retail, mostly I can put it. It's my judgment. I can put it under office building. You can keep it. Okay, right. So if that is the situation, all these three will be one category. Next, he is talking about computer sales, administrations. Okay, that's fine, different. We'll come to that. Next, first one, vacant land. This alone is one classification. Listen, my dear, khali land without any khali land. What do I say? Land without building. You should make it one freehold land, something like that. We write it. That is separate classification. You should keep it. Land with building, separate classification. You should keep it. This alone, again, landfill, this is a different kind of purpose. It is not for office building or not for that purpose. Not for office building, not for the khali land, for going to use it something. No, that kind of thing also. See, any dem, the classification, when you say the classification, this is based on, what is the basis, sir? How are you doing it? That you should question, correct? Na? It is based on same nature. Based on same nature and usage. Based on same nature and usage. This is the criteria, first criteria. Right. Usage is different. Correct, na? Right. This is nature of it is khali. It's different. With building, it is different. Okay. So deciding criteria is, if you want to put all the items into one class of item, means their nature and usage must be same. Then it works. Then next, come to the equipment. Equipment A, equipment B. Okay. Computer systems as its headquarters and direct sales office that are integrated with point of sale computer, whatever, in the retail outlets. Point of sale computer systems in each of its retailers. It's okay, we can combine them as one category. Next, furniture fixtures in administrative headquarters and sales office. Furniture fitting in, this is shop fixture. Shop fixtures and administrative fixtures are a bit different. No, don't, because their usage will be different. Obviously usage will be different. Administration furniture and fixtures are different, and outlets shop fixtures are entirely different. Their life is different. Their what is that, nature and usage both are getting different. This alone will be one class, this alone can be one class. That makes more sense, right? That is what, when you are into in your articleship period, if you look into the balance sheet and etc., that time you have to look into this. Generally will follow whatever previous year what they followed, same thing, start calculating depreciation, correct. But sometimes they must have not done correctly. We can suggest them. Suggest, don't fight, correct? No? Suggest, tell them. If they listen good, do not listen very good. That's all, correct? No? Right. Chalo. IND AS 23. IND AS 23, that is borrowing cost, and 109 financial instruments. How will you capitalize the interest when qualifying asset is funded by a borrowing in the nature of bonds? Bond is a debt which are issued at discount. Let them, right? We'll calculate what is there, correct? Right. Y Limited issued at the start of the year, beginning of the year, 10% interest 10% interest paid annually, having maturity period of 4 years. Face value is equal to this, discount is 10%. Done. To finance a qualifying asset which is intended, correct, which is ready for intended use at the end of the second year. That means what? You have to write some sentences with respect to IND AS 23, correct? Borrowing cost, you have to capitalize for the first 2 years. Only 2 years we are supposed to capitalize it, right? And wherever it is interest expense or interest income, it has to be at the effective rate of interest. It is not normal, okay, and not the coupon. I mean to say, coupon is 10%, my dear. 10% is useless for my accounting. Okay, only for payment purpose that is necessary, right? And compute amount, what is that? Capitalized if the company discount effective rate of interest is 13.339. They only told. Excellent, right? See, first day when you have issued the bond, correct? Now you issued the bond. What is the journal entry you must have recorded? You must have got how much cash, my dear? Cash account debit. Cash account debit is equal to 1,80,000, and two bonds actually 1,80,000, not 2 lakh, because it is issued at discount. That is, obviously borrowing cost, transaction, whatever, it is supposed to be reduced from your loan itself. Let me see the question over. Okay, done. Doesn't matter. How much to capitalize? Correct, na? What do I do? Simple. Year 1, as usual, opening balance. Correct, na? Interest at the rate of 13.39%. Correct, and payment, right, and closing balance. Agree? Done. So opening balance of loan is how much? 1,80,000. Yeah, into 13 point, correct? Now 1,80,000 into 13.39%. That comes to 24,102. Correct. And interest is paid annually, having a maturity of period of 4 years. Correct. Only, okay, interest payment is happening, but actual payment of interest would be how much? Coupon rate. Correct. Na? So 2 lakh into 10% means that is equal to 20,000 you are going to pay. Done. So it's 1,80,000 plus, and this 20,000 minus, that comes to 1,84,102. Correct. This is first year. And second year 1,84,102, yeah, into 13.39% comes to 24,651, and our payment will be 20,000. This is nothing but amortization table we call, isn't it? Right? So 20,000 plus 184,102, right? So it is going to 188,753. Correct. What is the interest you will be capitalizing? This amount is going to be capitalized. Next 2 years interest will come, that will be charged to profit and loss. Capitalization purpose also, charged to P&L purpose also. Interest is interest, it is always calculated using effective rate of interest method, except in case of FETPL classification. Okay, right, we assume obviously this loan is amortized cost, you must have followed, that is the basic assumption. Okay, because there is no mean or necessity to follow FETPL for this liability. Okay, right, that's it. Next, from this is very basic question they have asked, fine, doesn't matter. From the following data, identify the nature of activity, identify the nature of activities. Okay, identify the nature of activities as per IND AS 7. Done. Cash paid to employees, nature of activities, you just say operating or investing or financing, that's all. Very basic question, never expect such kind of question in the exam. Cash paid to employees, obviously operating. Cash paid for development of property cost, investment. Borrowings repaid, that is financing. Cash paid to supplier, operating. Loan to director, loan given, correct, not loan taken, that is investing. Bonus shares issued, non-cash. Yeah, there is no cash. If it is bonus shares issued, non-cash, do you take into cash flow statement? We don't take. But aren't you supposed to disclose it? Yes. All material non-cash also supposed to be disclosed below the cash flow statement. You have to say that. Dividends paid. Yes, this is payment of dividend, no, financing. Right. Cash received from trade receivables, operating. Proceeds from sale of PPE, investing. Depreciation, again this is non-cash, it doesn't need any disclosure. But if you are preparing cash flow method, cash flow under indirect method, then you will be taking for reversal, correct, plus or minus non-cash and non-operating items there. Advance received from customer, customer is operating. Purchase of goodwill, yeah, goodwill means is an asset, intangible, investing. Payment of promissory notes, promissory note means you have taken a loan, correct now, so this is a financing activity. That's it. Okay, right, let's get into the 9th one. Right, it's based on IND AS 40, which is investment property. Excel Limited owned a land property whose future use was not determined. See, when you hold something where you don't have, uncertain or undetermined usage is there. Okay, we have not fixed it, like let's construct an office building over here or whatever it is, they have not decided anything. Under that circumstance, it's going to be investment property. It is investment property. Words you have to, if you have read the standard, that's what I'll tell. Sir, sums karenge sir, correct na, sums karenge, then sums based will come to this. No, unless until if you read entire standard perfectly, you cannot handle such kind of questions. Right, that is the problem. One small twist if he gives also, na, then matter finish. At all your hard work, just you want to get correct, na. Normally you, obviously all the students work hard, you are at final level. I have due respect to you. The reason you already semi-qualified, right? Without effort you would have not become semi-qualified. Agreed. So that's why, just for 20% benefit ke liye shortcuts if you choose, no, then you will face unnecessary problems. That is correct, na? And start early, bit early. If you want to 6 months before only try to start preparation, bit serious, then obviously sky is the limit for you. Done. Okay, as at the 31st March 2001, how should the property be classified? Investment property. Alright, as on 31st March 2001, over answered. During June 2001, that is in the next year, they commenced construction, okay, office building for its own use. Commencement means there is an evidence. Isn't it evidence or not? Yes, there is an evidence. It is not just intentions of the management, it is an evidence. You started constructing. So the minute you started constructing, this is for which one? For own use. That is owner occupied property, which is nothing but PPE. Owner occupied property, which is nothing but PPE. Okay, you should reclassify. Done. It was classified as investment property. Now reclassifying as PPE. Correct. Right. At what amount? at the same amount, at the carrying amount, in the same whatever was there in the books, same amount only. Means what is the journal entry? If you can say PPE account debit to investment property. There is no gain, there is no loss for reclassification. Asset is yours. You had the control over the asset earlier. You have the control over the asset even afterwards. This classification is changing within your books. It's not moving to other books. Then why profit or loss? Obviously, it doesn't make any sense. How should the land and property will be classified by X Limited on 31st next year? I told already PPE, because there is an evidence. Okay, reclassification you should do. Will there be a change in the carrying amount of PPE? No, it will be same amount. No gain, no loss. PPE debit to IP. Whether the change in the classification to our investment property is a change in accounting policy? Yeah, not at all. Read IND AS 8. We said there it is not a change in accounting policy because the usage is getting changed. That's why classification is getting changed. It's not my choice. Okay, right. Do you answer to A above? Will it be different if there? I mean, what is the first one? Above means this one. Were to be a management intention to commence the construction for the own use. However, no construction activities placed on this one. No, it will be IP only. Why? It is only management, correct? There is no evidence. Yeah, for the classification change. What did I say? If you want to change the classification, there should be an evidence. If there is an evidence, then only will change the classification, not based on the intentions. This is discussed as part of IND AS 4.0. Okay, right. Come to 115. This is also one of the good sums, I can say. Right. Okay, you have to apply a little knowledge of IND AS 115. Not very big one, simple one, good one. Okay, property sale contract includes the following. Okay, common areas, right? Okay, common area. Common area means, I mean, when you purchase one flat, obviously common areas will be there. That is construction services and building material. See, what is he asking? First, let's look at the question. Analyze whether the above items can be considered as a separate performance obligation as per the requirements. Means just identify how many separate performance obligations are there. First, what is performance obligation? Performance obligations are distinct goods or services. Correct, na? Right. Or it can be series of distinct goods or services. Okay, series of distinct goods or services we are entering in one particular fashion. Right. Next, sir, you're saying distinct. What is distinct? Distinct means, I mean, the customer can be able to use it. Correct. If I give one item, one computer, correct. Say example, I'm giving this. Assume this is only computer. Yeah. A computer he can start using on its own. I mean, it doesn't need any other item. I mean, support is not required. I can use it on its own, or it can be used with what I have already. Customer has. Okay, that means it is independent. Like, it's not like, okay, sir, I am giving you this also I have to give it to you, sir. Together only it will work, sir. Without that, this also will not work, that also will not work. Yeah, if customer says, no, like this I have one more. No, sir, that will not work. It will work only with this item. I cannot buy it from outside also. Then it is together is equal to single performance obligation. We don't treat them separately. Okay, right. If it is independent, I can say, then this different. I mean, separate performance obligation. Chalo. Fine. So you have to identify. So what are the items? Just read through. Common area, construction service and building material is giving, property management services, golf membership, car parking, land entitlement. Okay, now listen. See, my dear, common area, construction services and building material, obviously is one performance obligation within one performance, because common area, one small thing. See, I'm staying in apartment. Common areas is I also get. Correct, na? See, seriously, what do we say? Example, say 2000 SFT, I have paid for 2000 SFT. But am I staying in a house for 2000 SFT? It is not. Maybe my place is equal to actually 1500 SFT. A 25% is for common area. Right. One question. Can I sell this common area 500 here? 500 SFT, can I sell it to somebody? Or you purchase only common area? That means the customer cannot use it separately, independently, individually. First, I only can't transfer means where he will do it. Then how can it be separate performance obligation? Nothing. It's part and parcel of building construction only. Building construction material, are you giving me building or material separately? Yeah, right. Obviously, it's all one and the same. Property management services. This is for maintenance and etc. That is a different job. That is nothing to do with the building. After construction of the building, maintenance comes into the picture. So it is not necessary. I mean, separate. It is separate PO. Even golf membership. This is separate. It is nothing to do with the building. That, I mean, total purchase concept. I mean, total transaction price is supposed to be bifurcated between the building cost, management services, and golf membership. Correct? No? Car parking. Car parking can, I mean, what can happen? Car parking can be given separately. Agree? Correct. No? I can sell the car parking or I can rent the car parking. This is car without selling the building or flat. I can sell only car parking. Very much possible right now. Okay, right. I can rent it. I can do anything. Yeah, even though I don't rent the building, I can rent the car parking. I can sell the car parking. I can buy the car parking. Okay, got it? Right. It is separate. It is separate. What do you call separate performance obligation? You can say. Okay, land entitlement. Yes, if you are the owner of the flat, obviously you are the owner for the land also to some extent. Correct. But can you sell only land entitlement without building? Generally not possible. But if you say I can sell only land entitlement without the building, na? Right. Actually you cannot. That is what. You cannot. I mean, in case of apartment, you cannot do it. Right. We don't know exactly where it is happening. So that is you should write like depending. It depends on you are supposed to answer. It can be both. You can transfer and it can be used by the customer on its own. Then fine, that is a separate performance obligation. Otherwise, this is also part and parcel of, I mean, A, B, F can be one, and this is also separate, this is also separate, this is also separate performance obligation. Okay, right. 116, right. What leases? Entity X is an Indian entity whose functional currency is Indian rupee. Then it has taken a plant on lease, right, from entity Y for 5 years to use. Then manufacturing process. Okay, we took the plant for the lease purpose to pay annual rents of $10,000 every year, arrears at the end. On the commencement date, exchange date is what? 68. The average rate I mean for year 1 was 69. At the end of the year it is 70. The incremental borrowing rate is, I mean, obviously USD, because it's happening USD, right? So obviously you have to consider that country's rate, and because lease is happening there. Okay, if you consider here, it doesn't make sense. 5%. How will the entity measure the right of use asset and lease liability initially and at the end of the year 1? Very simple. Correct. Now, what are you supposed to pay? You are supposed to pay $10,000 for 5 years. Number is same. Correct. So can I apply present value annuity factor? Very much. At the rate of what? 5%. Correct. No? Right. So what is that? I mean, 1 divided by 1.05. Correct. 1, 2, 3, 4, 5. Yeah, GT comes to 4.3, I say 33, something like that. Okay, into 10,000 if I keep, that comes to $43,295. Correct. This is the present value of lease obligation. Okay, right. So now what are we supposed to do? This you have to record in the country, you know, in India, Indian functional currency, then translate it. Translate it using which rate? At the rate of 68. Yes, multiply with 68. That's it. You got how much? 29,44,044 rupees has come. This number is your, what is it? You will be recording ROUA account debit, correct na? And to LO, lease obligations. Lease obligation is a loan, borrowings. Okay, right, it's a borrowing. You are supposed to, right, treat it like that. Got it? The E number will be done. Next, what will happen at the end of the first year, right? Yeah, will you be paying? I mean, what are you supposed to do? Are you supposed to increase it, unwind it? Correct, unwinding. Unwinding, which one you are supposed to do, my dear? Not this 29,44,000, you have to do 43,295. Got it? So I mean, where should I do? If 43,295 into, I mean, this is the opening balance of my liability. First, I'll say this is opening balance of my liability in dollars. We'll calculate everything in dollars. Later, we'll turn it to rupees. Okay, and what is that? Interest. Interest at the unwinding at the rate of 5%. Correct, na? 49,290. 49 or 43? Yeah, 43. By the time it came, 43,925 into 5%. So that comes to 21. Okay, 2196. Right, and your payment, you must have made already $10,000 payment. Correct. So then this is what is your closing obligation, right? 43,295. That comes to 35,491. Yeah, isn't it obligation? Yes. Isn't it a monetary item? Yes. Is that monetary item you have recognized at 68 only na so far? Yes, yes, we have recognized so far 68, but on the balance sheet date, what is the rate? 70. Correct, na? Right, into 70 minus 68. Correct, na? That will be transferred to P&L as fluctuation gain or loss. It's a loss basically. Then at the same time, interest is being paid at the end, year end. Correct, na? So this number into 70 will be my interest expense. Will be my interest expense. Got it? Right. So even this one also, 10,000 into 70 is what my payment. Because this is also happening arrears at the year end. Hope you have understood. Automatically it will set right. Right. Nothing much. Just I mean, trying to what do you call? Confuse us with the different currency. Otherwise, there is nothing great as such. Okay. Right. First you do as if it is rupee. Then after completion, then start multiplying with the rates. It will work. Done. Next question. Okay. Yeah, just a second. Yeah, sorry. Company P is a holding company. Okay, P is the holding parent company, and for the B is a subsidiary company. A group share-based payment is being organized in which parent issues its own shares to employees. Okay. So number of employees of B, correct? Na? See, a group company, I mean, in which parent issue, who is issuing? First of all, parent is issuing to whom? B company employees. Correct? Right. It is not by the same company. Parent is issuing to the subsidiary. Very simple. I mean, it's not nothing much. Parent is issuing means first parent has to recognize. Correct. You have given it to whom? My shares are being issued. Okay, we'll say 2 equity share capital, you will say 2 security premium something, you will say, because our shares are being issued if at higher value. And have you got any consideration? No. Then how do you recognize it? We'll recognize it as investment. That's it. We'll recognize as investment in the subsidiary account debit. Right. At fair value, same thing. I mean, there's no difference. Number of employees are 100. Number of shares granted is equal to 25. Correct. Face value is equal to 10. Immediately it's happening. Correct. So you don't need to make a reserve. SBP reserve is not required. Later converting to equity share capital not required. Directly we'll write. Fair value is what? 987. Then that's it. So equity share capital, what do you do? 25 into 100 and into 10 face value. Then 25 into 100 into 77 will be security premium. Obviously the total will be the investment in B. Correct. And what this is the journal entry in the books of parent. And sir, what about the journal entry in the books of company B? Correct. Yeah, we are supposed to recognize our employee benefit expenses. Correct. But you are not giving any money, na? Yes, we are not, because employees are serving our company. We are getting the services or we are getting the goods. Correct. That's why we should say employee benefit expense account debit to, it is like you can record as a capital reserve, because freely we got the services. Freely we got the services from the employee. For this, consideration is not paid by me, it is paid by the parent company. That's all. So இதே number, same number, whatever we calculated total, that will become right. It is like a contribution received. Capital contribution received is nothing but capital reserve. It's part of other equity. It's part of other equity. Okay. Done. Next question number 13, IND AS 103. Done. Bima Limited acquired 65% of shares on 1st June. Okay. In NAFA, which is engaged in production of whatever this, correct. We got 65% means we can say we got control. So Bima is the parent of NAFA. NAFA has 1 lakh shares. Okay, NAFA has 1 lakh shares means 65% means 65,000 is with us. That means I can say 35,000 is nothing. 35,000 shares are held by NCI, non-controlling interest. Done. And the quoted market price of these shares is equal to 12, they said, on the date of acquisition. The fair value of NAFA identifiable assets are given. Bima wired means transfer of money, bank, 50 lakh in cash. Mean transferred cash includes cash in hand, cash at bank. Okay, right. Issued 50,000 equity shares as a purchase consideration on the date of acquisition. The quoted market price of that means, see, what is he trying to ask? First question is what? Let me see that. How will the acquisition be accounted by Bima? Accounted by Bima under IND AS 103. Okay, in parent company, how will he recognize it? Prepare any working and past necessary journal entry. Okay, that means first you are supposed to calculate. I mean, simple. What have you given here? Simple. We will directly write. Working also not. I mean, you can do it. I don't need to do it. Yeah, I can say 2 bank. I can say first 2 bank. What have you given through bank? That is 50 lakh. Right. At the same time, have you issued shares also? Yes, we have issued. What is that you have issued? Equity share capital. Has he given face value by chance? If not, no problem. That is equal to nothing but 50,000 shares you have given and 25. Right. So 50,000 into 25. That comes to 12.5 lakh. 12.5 lakh. Done. Identifiable assets, correct. Now, so then I can say assets account debit. Assets account debit 80 lakh has come. Done. Next, Bima Limited agreed to pay additional consideration of 15 lakh if means subjective. Correct. Na? Subject cumulative profit earned by the NAFA exceeds 1 crore over the next 3 years. Contingent consideration. On the date of acquisition, NAFA Limited assessed, determined that it is considered probable that there will be extra consideration will be paid. Whatever. The consideration, contingent consideration should be measured at fair value. Okay, right. In fair value computation, whether probable, not probable is obviously being considered. Understand? So you have to recognize that as a liability at fair value. Fair value is given this. So what is it? Contingent consideration. Contingent consideration 9.8 lakh I will be recognizing. NAFA incurred 1,50,000 to this. Standard is very clear. That should be charged to P&L. We don't, consider it at all. Directly expense account debit to P&L. It measures non-controlling interest at fair value. Okay, non-controlling interest at fair value. So to NCI 35,000 shares are there. What is the rate here? 12. Okay, that is the number. Okay, 35,000 into 12. That comes to 4.2 lakh. Now let us see 4.2 lakh plus 50 lakh plus 12.5 lakh plus 9.8. Okay, 76.5 is coming minus 80 lakh. That comes to goodwill. Goodwill amounts to 3.5 lakh. That's it. Yeah, directly you can calculate. This is our balancing figure. You want to put it in one proper table, put it, that's it. But anyhow, end of the day, that only will good, right? For understanding, this is more than sufficient. Next question, IND AS 41, this same thing. I mean, obviously many of them are there in our material, right? But conceptually it's been already covered, not line by line, exactly word by word, number by number. Obviously I don't think so you expect at final level, correct? Now concept, if it is clear, then you should be able to handle it. Let them ask whatever the fashion they want, correct? Now that's all. Any day, that is what the confidence, right? End of the day, blaming ICA, blaming somebody is useless, correct? Now how can we blame here at this level? Not. So, right, analyze whether the following activities will fall within IND AS 41, that is agriculture, correct? Or proper reasoning. Then reasoning, I mean, you have to write, I will explain. Obviously answer is given below, you know that. All right, analyze whether the following activities will fall. See, when do you say it's an agriculture, there should be, I mean, agriculture activity, management of what do you call transformation, agriculture transformation, that must be happening. Means my company should be doing something for that. Then it is agriculture. Sir, my company does nothing, sir. Then how can you say it's your agriculture? Right? Obviously not. Right. Chalo, look at the point. Managing the animal related to recreational activities in the zoo. Okay, in the zoo you have animal. Is it part of agriculture? Your primary purpose of having animals in the zoo is not for doing some agriculture activity and get the money from that. No, it is for the entertainment purpose, recreational, they only told. No, zoo, those animals in the zoo, correct? Livestock, no, it cannot be considered as agriculture. There is no agriculture activities going on. Obviously you may be feeding them, right? That is part and parcel of your business purpose, but there is no agriculture is involved. No, I cannot treat them as 41. Then where should I put it them? It is like PPE, correct? Now you should treat it as PPE. Why? Because with them, with the help of this, you are making money if you want to account. Got it? Right. Fishing in the ocean, what are you doing? Going and catching, but you are not feeding. There is no management, correct? Now we are doing nothing, we are not helping any fashion, just catching. So there is no agriculture activity, it's not going to fall under 41. Fish farming, yeah, this is yes, this I am taking care of, correct? Now I am taking care of fish farming, correct? Now we are, I mean, we are feeding, we are taking care, everything is done by me, and this is yes, it is part of 41. Development of living organism such as cells, bacteria, virus. Here one has to stop and think. Yeah, what is that you have to stop and think? Why? What is the cells, bacteria and virus? What is the purpose? Right. See, there can be two purpose. One is, sir, I'm doing some intangible asset research and development activity. I am doing it, sir. What are you doing? Research and development activity. Yeah, why not? Correct. Now research and activity I am doing, then it is intangible asset, you have to refer IND AS 38, correct? No, this is going to be used in the business, correct? Now we'll take this cells, bacteria, virus, development of this, I mean, how it will be useful for my agriculture activity, this is going to help me. Then it is going to be 41. Means purpose is important. Ultimately, what are you going to do with this? Sir, I will do this, I will develop these things, I will find out something, one medicine or something like that. Then it's going to be intangible asset, not agriculture activity. It always depends on for what purpose you are doing in this case. Next, growing of plants to be used in the production of drug. It's plantation you are doing, agriculture only you are doing. You may use it for your purpose only, or you plant, you cut it, and seeds you sell it, correct? Leaves you may sell it, whatever, that's a different case. Ayurveda, something you must be doing it, that may be your ultimate one. But this is agriculture happening, we are taking care, there is a management of everything, correct? Right. Obviously it is 41, part of purchase of 25 dogs for security purpose, correct? But it is not agriculture activity, my dear. Okay, obviously it is for security purpose, you only told. That is not your, I mean, your business. Buying, correct? Now, buying, selling dogs is not your business. Fine, right? It is not at all 41. Got it? Right. Chalo. Next question. IND AS 109. Obviously simple and beautiful. On 1st April 2001, okay, Sun Limited guarantees 10 lakh loan of subsidiary, okay, Moon Limited, which bank STDK has provided to Moon Limited for 3 years at the rate of 8%. Banker has given loan to our subsidiary, we have given a guarantee, okay. Interest payments are made at the end of each year. Principal is repaid at the end of the loan term, means after the 3 years you are going to do it. If Sun Limited has not issued a guarantee, okay, Sun Limited has not issued a guarantee, bank STDK would have charged Moon Limited at the rate of 11%. Okay, that means it's because of the guarantee given by the Sun Limited, it has come down. 11 became 8. Okay, in the questions it will be possible to give, practically nobody will tell that. Okay, I mean practically banker will not tell. Without guarantee, what rate would have charged? They won't tell only. Getting the information from the bank is very difficult in this case. Sun Limited does not charge any Moon Limited for providing the guarantee. Okay, on 31st March 2002, there is 1% probability that Moon Limited may default on the loan in the next 12 months. Okay, probability is 1%. If Moon Limited defaults on the loan, Sun Limited does not expect to recover any amount from the, okay, I don't get any money from the Moon Limited, right? On 31st March 2003, there is 3% probability, means 31st March means year end May, 3% probability that Moon Limited may default on the loan in the next 12 months. Means increased, but it is not a significant increase. Correct. Now, okay, 1 became 3, fine, it's not significant increase, fine, I'll consider it when I'm answering. If the Moon Limited defaults the loan, Sun Limited does not expect any recovery, okay, fine. Provide the accounting treatment of financial guarantee as per IND AS 109 in the books of Sun Limited on initial recognition and subsequent measurement. Okay, yeah, so this is the good one actually. Let us do it properly. I need obviously whiteboard, right? Just a second. Yeah, let me do it properly, I mean in detail. See, first of all, when it is what is that? It is a financial guarantee. Financial guarantee, correct? Now, as per IND AS, right? IND AS 109. As per IND AS 109, financial guarantee. Okay, financial guarantee, right? Financial guarantee is a financial liability. It is not a contingent liability. It is not contingent liability, right? It is not contingent liability. Done. So this financial liability, if financial guarantee is financial liability, this will be initially it will be recognized, right? Initial recognition and subsequent in the sense on the balance sheet date. Done. Yeah, if it is initial recognition should be at fair value. That's it, at fair market value. At the fair market value means what, sir? See, the standard has not given any guidance with respect to fair market value. So what are we supposed to take it? If I have given any such kind of guarantee, if the banker, what would have charged if banker has given the guarantee, that you can take 1, right? R means what did I say? If banker also will give you bank guarantee, correct? Now here guarantee is given by whom? Holding has given guarantee to the banker. Now we are bothered about what will be the journal entry in the books of holding, because holding has given a guarantee, so it is a financial liability to the holding company, correct? If banker had given such kind of bank guarantee, how much they would have charged, that much we can take it. That is method 1, right? And method 2 is what is the benefit accrued to my subsidiary? What is the benefit accrued? What is the benefit accrued? Without guarantee, banker will charge 11%. With the guarantee, banker is charging 8%. So our difference is what the benefit accrued. Agree? Right. So that difference amount in present value computation, obviously you are supposed to do it, because benefit is say 11%. I don't remember the number. I think 10 lakh. Yeah, 10 lakh. So 10 lakh into 11%, 1 lakh 1 lakh 10,000 you have to pay per annum interest. At 8% means 80,000 you have to pay interest. Correct. Now that means what is the benefit accrued? I mean, that is, I can say that is nothing but per annum 30,000 rupees is the benefit accrued. To whom? Subsidiary. Correct. So this present value means market rate. Market means market may for such kind of interest is at 11% they are charging. So this is for the first year, this is for second year, for the third year. Right. What is the present value of it? Yeah, find out. You directly apply present value annuity factor at the rate of 11%, because market rate, when you take only market value, you will get it. Right. So what do you do? 1 divided by 1.11 3 times. I mean, yeah, you got, what is the 2.4437 something you got it. 2.4437 means, okay, let me make it, this is also 4. Okay, 2.444 into 30,000. Yeah, into 30,000, that is equal to 73,320 is the fair market value on the date of loan. On the date of loan, which is it? On the date of loan, that is 1/4/2001. Let's say 1. Okay, right, 1/4/2001, this is the fair value. So must recognize at fair value on initial recognition. Got it? Right. So let me go here. Yeah, what is the number it has come? It is at fair value. What is the fair market value? Fair market value is equal to 30,000, correct na, into present value annuity factor at the rate of 11%, because that is the market rate. Without guarantee, what is the rate? Then you will get to know exactly. So that is equal to 2.444 has come. E number comes to 73,320. So you are recording in the books of what? You are recording in the books of parent. Yeah, in the books of parent. Okay, right. So now what is the journal entry? What is the journal entry? You have to recognize financial liability. Okay, say to financial liability, 73,320 you will record it. Then, sir, what is the debit, sir? Debit, are you getting any consideration? They said very clearly, we are not getting any consideration from subsidiary. That means it's a capital contribution to them. For me, I mean for the parent company, it's an investment. That's it. You can charge it to profit and loss amount. There is no guidance actually. It is as per the accounting policy of the company. It's a choice. It is purely a choice. Got it? Right. I am taking it this way. This is investment in subsidiary account. Investment in subsidiary account debit 73,320 rupees ko we are recognizing initially on 1/4/2001. Correct? Now this is on 1/4/2001. Next, as per the standard, a financial guarantee, subsequently how are we supposed to measure it? Correct? Now subsequently how are we supposed to measure it? Subsequently, you know, the allowance amount, what do you say? Loss allowance I can call. Loss allowance. Loss allowance means, you know, loss allowance means in case of default, what is the probable expected loss if default takes place? Are you getting my point? Right. What is the loss expected amount on the date of balance sheet? Subsequent means on the balance sheet date. On the balance sheet date. Or carrying amount. Okay, na? Carrying amount. What is the carrying amount? Carrying amount of financial liability, whatever you have taken. But if financial liability, it will not be same 73,000. Will be amortizing, right? E 73,000 is going to be amortized over the period of 3 years. Yeah, it will be transferred to profit and loss, obviously. I will tell that. Okay, whichever is higher, a number should be there in the balance sheet. That number should be there in the loss allowance or the carrying amount. Whichever is higher, that should be there in the balance sheet. Now let's read the question once again, right, and come back. See, first point is 1st April 2001 they told. Done. 1st of April 2001 journal entry is completed. Now come to 31st March 2002 at the end of the first year. Right. There is 1% probability that it may default on the loan. Okay, that means what is the loss expected? The loss expected is equal to total 10 lakh into 1% chance. Yeah, we can consider, always will calculate expected loss like this. Okay, right, that is equal to how much? 10,000 only is going to come. Our carrying amount you have to check. Let's do some, carrying amount, what would be first to determine? Whichever is higher should be on the balance sheet date as a financial liability. Okay, right, 1% is made default. Okay, does not expect to recover any amount from. Okay, doesn't matter. Yeah, we don't expect any money from the one we are saying. At the same time, to occur such kind of incident is hardly 1%. That's all. So the fair value or the expected loss is equal to 10,000. Yeah, this is next year, that I'll come back. First, let me account the first one. Right. So let me write it. I'll say, how do you, first to opening balance of financial. This is financial liability. I can say amortization kind. Amortization table. Okay, amortization table. You have discounted at the rate of 11%. Then obviously unwinding also you are supposed to do interest at the rate of 11%. You have to do it. Okay, right. At the same time, what is the next? Amortized. It is, you are not going to pay, you are not going to say, amortized to P&L. Yes, you will be transferring it to P&L. This is the closing balance. Done. Right. So what do you do? What is the number here? 73,720 is the opening balance. This number has come at the rate of 11% into 11%. That comes to 8065. Okay, right. This is going to be a charge. This is an expense. Obviously, loan increasing means expenditure. Amortize, we'll do 30,000 rupees should be transferred to P&L. Correct, no? Obviously, because 30,000 is the real benefit what he is getting per annum. Right? Who is getting not cash benefit derived by the other party. 1 year is over, so total 90,000. 30. In present value terms, it was come to 73,000. When you're unwinding it at the end of the first year, the benefit what they derived is 30,000 only. Right? So what do you say? 73,720 plus 8065 minus 30,000 comes to 51,785. Yeah, see, this also will go to P&L. This also, both will go to P&L. Next, this is for year 1. This is for year 2. That is 51,785. Yeah, into 11%. That comes to 5696. Okay, right. And 30,000 you are supposed to take it to P&L as an income. Right, minus 30,000. It will come to 27,481 or 2 something. Okay, 27,482 into 11% comes to 3023. Okay, yeah. So that will come to, obviously, that is equal to, I think it should maybe some difference will come because of fraction. Okay, right. That ignore it, whatever it is. We will adjust it in the amount. There will be some difference, expect that. Fine, doesn't matter. This had to become 0 at the end of the 3rd year. Guarantee period is over. I am no more liable to the banker because, correct, no? Right. So now this is the number. This is on which date? This is 31st March 2002 number, carrying amount. Correct, no? Now let us see. 31st March 2002. This is the first, first year end. Right. Y1 ending. Now what is that? Subsequently you are supposed to, correct, now subsequently we are supposed to measure. Subsequently measure financial liability at, yeah, at what amount? At what is that? Loss for allowance. Expected loss, basically. Allowance for loss, whatever you can write. 1. And the second one is carrying amount. Right, carrying amount. Whichever is higher, I said. Loss for allowance, I said 10 lakh into 1%, which is equal to 10,000. And my carrying amount is equal to 51,785. This is the carrying amount closing balance. Got it? Right. So whichever is higher, 51,785. Right. Is it already there or not? Yes, it is already there. So since it is already there, do you need to do adjustment? No adjustment. As carrying amount, correct, na? As carrying amount, is higher, is higher, is higher, no adjustment required. Do you need to do adjustment? No adjustment is required, right? But are you supposed to record journal entry for the interest portion and this portion? Then actually what you will do, net effect only you can directly transfer it to profit and loss. Yeah, right, right. One on this date only. Yeah, transfer net effect, transfer net effect, net effect to P and L, net effect to P and L. What is transfer net effects are 806, I mean 30,000 minus 8065. Yeah, 30,000 minus 8065 comes to 21,935. It will come, right? So your liability should go up, right? Sorry, yeah, your liability, what is the liability should come down. E 73,000 should come down to 0, right? Then what do you say? Financial liability account debit 21,935, correct? Now to profit and loss, it is an income. Reduction of liability, it's an income. 21,935, we will record it on 31st March 2002, right? Now let's come to 31st March 2003. What will happen? Yeah, simple. Again, today what is the carrying amount? First assume your, right, what do I say? First journal entry for year 2. Let me record it. That is better. That is equal to net amount. What is the net amount? Net amount is equal to 30,000 minus, correct, na? 30,000 minus 5696. If I take it, 24,304 is coming. Okay, 24,304 is coming, right? So journal entry will be same. That is FL account, financial liability account debit to profit and loss. 24,304, 24,304. We wrote it. Done. So now what is the carrying amount? Now carrying amount. Yeah. What is the carrying amount, my dear? Carrying amount has come to 27,482. It came, correct? 27,482 is the number. And what is the loss for allowance? Allowance for loss. Allowance for loss is equal to 10 lakh into, now it changed to 3%. Yeah, 3% means it is 30,000. Whichever is higher. So it should be what? So FL should be at what number? FL should be at 30,000. But what is the number? Only 27,482 is there. Correct. Now increase it. Are you getting my point? Yeah, you are supposed to increase the financial liability. Yeah, increase in the financial liability. Now you don't need to again hit to, what is that I mean to say? You don't need to hit investment. Okay, that increase in, it's already liability is recognized. Increase decrease will go to P and L. Got it? Right. So increase it by what number? That is 30,000 minus 27,482. Okay, right. 30,000 minus 27,482 comes to 2518. Right. So what do you record? Now you should say P and L account hit to financial liability 2518. Or you can pass one single journal entry. What is a single journal entry? Here P and L is what is happening, credited. Here it is debited. Correct. No? You can pass one journal 24,304 ko cut karo. But kiya to actually 21,786 ko, if you can record one single net journal entry also can be recorded. That is about this sum. Good one. Actually, we should, I mean, you are supposed to revise it. It can be expected. Such kind of question can come in exam. Very much expected. Okay. But they have not given great information data with respect to financial liability, that is financial guarantee, but directly they are asking such kind of, very light information was given. Doesn't matter. It's our job. Right. First you want to write it. You can pause the video. Pause. Done. Yeah. Next question 16. IND AS 1. Nothing great. Basic one. An entity has the following trial balance line item. Trial balance items are there. How should these bill be classified as current or non-current is their question. Okay. Receivables he is talking. Receivable is asset, current asset. Asset basically. Current or non-current means, if you remember the definition as per IND AS 1, first only what is it says? Which is expected to be consumed in or expected to be sold within the normal operating cycle. Correct na? Expected to be consumed or used or sold. Correct na? Right, within the normal realization also. Realization within the normal operating cycle. Right. See, the sentence first part should be applied only for the operating asset. Receivables, payables, all advances and etc. all are obviously arising from the operating asset. So one has to look at the normal operating cycle, but not the 12 months category of third bit. Right. Since receivable is purely operating, correct na? Purely it's arising from the operating, it generally will be part and parcel of current. Okay, it is not general, it has to be part and parcel of current. Then I'm concluding this is a current asset because it is arising from where? Operations, and the collection period is also part and parcel of normal operating cycle. It cannot go to non-current. Okay. And one point they say generally, if the normal operating cycle is more than 12 months, you have to give a disclosure. Okay, but current is current only, you have to just give a disclosure. That's it. Next, advance to supplier. Yes, advance to supplier also operating asset. Yes, normal operating cycle. It has to be under current only. Income tax receivable. He said other than deferred tax. Why he said? Because deferred tax is always non-current. Deferred tax cannot be current. Right. The income tax receivable, it depends. When are you expecting to receive? If you are expecting to receive within 12 months, it is current, otherwise non-current. We can't conclude it. Yeah, you have to write like that only because nobody can answer. Next, insurance spares. Okay, basically spares. When I say spares, what do you call? Add-on assets. Correct, na? Standby equipment you call, that is add-on basically. Correct, na? These assets, they have given very clear guidance under IND AS 16 as well as 2. Right. What is the question? Does it qualify? Does it satisfy PPE definition? That is the basic question first you will ask. If you say yes, is it PPE? Yes, sir. Then it will be classified as PPE. If it is a PPE, obviously non-current asset. No, sir, it does not satisfy PPE definition as per 16. Oh, then no, if you say, then it is inventory. The minute you say inventory, then it is obviously a current asset. It is obviously a current asset. Got it? Right. Next. IND AS 21 and IND AS 103. Linked. 103 basically. Fine. What is asking? On acquisition of mark, what is the value of the goodwill or capital reserve that should be recognized in the financial statements on the 31st March? Okay, 2003. Very good. Goodwill Limited acquired 30th September 2002. We acquired 70% of the share capital of other company. Registered in Germany. The functional currency of Moon, or whatever it is, Indian. Ours is Indian. Indian rupee. Others is German. Whatever, euro. The fair value of the net assets. Correct, na? Right. On the date of acquisition, what do I say? On the date of acquisition, this is, I'll say on 30th September. On 30th September. Identifiable assets, what you have got? 23 million. Correct, na? So assets, I will say directly journal entry. Assets account debit 23 million. Euros. Let me put everything in the euros. Later you everywhere multiply with the same rate. That's all. Nothing else. Right. 23 million euros. Let it be. And the purchase consideration what you have given. Correct, na? Let's say, let us say it is a cash paid. That is equal to 17.5. Nice. The exchange rate on 30th September. Okay, later everywhere will multiply with into 82 will multiply. That's a different case. And on 31st March 2003 was 84. That's we come to it later. Okay, next. On acquisition date, it's fine. Valuation of goodwill, capital reserve, it's all fine. But see, we acquired how much? 70%. But NCI is there for 30%? Yes. So NCI, then what are we supposed to do? NCI. NCI will be, has he told that it is at market, its fair value or proportionate to net identifiable assets? Fair value? Not told. Fair value is not given. So then I'll assume by, what is that? Proportionate to net assets. Your proportionate assets is how much? 23. So then I say 23 into 30%, because we have share of 70%. 23 into 30% comes to 6.9. It is coming to, right? 6.9. Now the difference, 6.9 plus 17.5 is equal to 24.4 minus 23 is equal to 1.4. That's it. 1.4 is the goodwill. Goodwill is 1.4. Right. On the date of acquisition, obviously, so he's asking goodwill or capital reserve. No capital reserve, goodwill. Goodwill is equal to 1.4 million into 82. That's it. Goodwill is not a monetary item to restate it. Correct. It is non-monetary, doesn't need to restate anything. Got it? No need of restatement. Whatever the answer comes, this is the same amount even on 31st March 2003 and even on 30th September on the date of acquisition as well. Same number. That's it. Right. IND AS 19. Right. E question, it's, in the classroom, so it is, basic question. Don't want to, general question. Nothing critical, normal. This, though, in our class we have discussed, I think two questions are same questions are there. Second question exactly, I think mostly amounts also tallying. Done. So I don't want to discuss because it is very basic. Right. IND AS 12. Yeah. The entity has identifiable assets, whatever it is, I don't know full form. Right. With a carrying amount of 10 lakh. Done. What next? Its recoverable amount is equal to 6,50,000. Carrying amount is equal to 10 lakh. Recoverable amount is equal to 6,10,000. Means impairment loss. Correct. Now, impairment loss account debit to accumulated impairment loss. How much? 3.5. 3.5. You are supposed to do it. Right. First, you have to pass the journal entry for impairment loss. Then you will come to what? 6,50,000 is the carrying amount. It is the carrying amount. Got it? Done. But the tax base is equal to how much? 8 lakh. Okay, tax base is equal to 8 lakh. 8 lakh means what? 1.5 is deductible temporary difference. Yeah, because you are able to get more deduction. It's an asset. So what is that? You are supposed to say deferred tax asset. Obviously, deductible temporary difference means asset. How much does it come? So 1.5 lakh into 30% he has given. Correct? Now 15, obviously 45. 45,000 will be deferred tax asset. Right, you have to recognize. So what do you regard? Deferred tax asset account debit to deferred tax expense or income, whatever, it will go to tax expense. 45,000 rupees ko you will be doing it, right? Assuming that, correct? Now what is that? It's probable that there will be taxable profits in the future with which I can offset this DTA. Okay, right? And even this 36th question of impairment also, my dear, very basic. This is goodwill is related to all the CGUs. So then what are you supposed to do? The CG first, you don't need to check for impairment loss for goodwill every year because it is not specifically related to one, it is related to all. So what should I do? First, if you find an indicator with respect to any unit, then check goodwill, impairment loss for that CGU. Then you have to check overall. Right. Then if there is any loss, that should be adjusted with goodwill. Okay. Right. That's why I've read the question. There is nothing much in this. Other questions are obviously a bit better. Yeah, answer is lengthy. When you look at the answer easily, you will be able to catch it. Hope you have, this video helped you to understand some concepts, at least one kind of revision. Right. Thank you, and subscribe to my channel for new and more videos.